those who are still in the process of joining, you probably will log in as we proceed. This morning, we are going to be discussing the proposals that were tabled yesterday by the Cabinet Secretary for Treasury and the Finance Bill. You recall, like 3 weeks ago, we had the same discussion. So today I will be joined by a panelist of three. That is Mr. Alpesh Banda, who is our CEO. He's going to be discussing the economic, part of this presentation. Then Mr. James Muridi will be discussing the income tax proposals, and Mr. Kevin Cherry will come with the direct taxes. My name is Michael Bulugo, and just to start off, as usual, today I have picked the days to see what they are saying about the speech yesterday by the CS. And I'm sure there on the screen, you can see what the people daily are saying. That's not PKF saying, this is the people daily. You can see what they are saying. They are saying is daylight robbery. These are conversations that every Kenyan, wherever they are, whether in the urban areas or the rural areas, people are discussing about the tax proposals. And when it gets to this level, where you have national dailies carrying these kind of headlines, it probably tells you where we are heading. But that is not all. I also have this other paper, the Daily Nation. And that is what it is saying. These are the headlines in today's papers. And this tells you that, Kenyans generally, the business community and everyone have a big problem with the proposals that have been put forth. For those of you who like to watch news, there was a very candid interview yesterday night with the PS, National Treasury, on the motor vehicle tax. And I'm sure you can rate that performance yourselves if you watch that video. So we will be starting with Alpesh on the economic issues. But remember, at the tail end, we would like to take all your questions. So you will go to the Q&A tab where you can post your question or comment, and we are going to be addressing that at the end of this discussion. So welcome, and we look forward to an engaging discussion with you for the next 2 hours. So over to you, Alpesh.
Thank you, Michael, and good morning, everybody. Before we kick off on the economic review, I think it's important to discuss the theme of the budget. I think this government is very much focused on the bottom-up economic transformation agenda. It's very much focused on debt consolidation, which is a fiscal consolidation. Our president is also very much focused again on climate change. We want to have 15 billion trees by 2030. And of course, the most important thing is to get people out of poverty. So those 4 areas are the main consideration by the government for this year's budget. We will discuss the economic review. We will go through the Africa economic rate growth to see how it's performing against the world economy. We'll also look at Kenya's sector growth, which sectors are doing well, which sectors need improvement. We look at the economics of Kenya, the inflation, interest, and bank rates. Public debt has been a big outcry. And I think the government, IMF, World Bank is very much focused on that. We also want to focus on Kenya's performance against our neighbors, how we are doing in terms of the growth and other stuff. We also look at petroleum prices. I think it's not only Kenya, but Africa itself, that we have a lot of external factors which affect us economically. So we need to look at all these issues together. We also, of course, look at the exchange rates. We all know how the exchange rates have moved in our favor in 2024. But what we're going to discuss is the reasons behind the favorable exchange rates Kenya is enjoying. And of course, the big discussion is the public debt, we'll spend a lot of time on. Looking at Africa's economic growth rate, I think the global growth rate has been less than 3%, and Africa has done well. We're at about 4.2% and projected to get to 4.5% by the year 2027. I think what is important to acknowledge is that by 2050, Africa's population is going to be 2.5 billion people, which is going to be 25% of global population. So I think Africa's turn to invest, time to pay for people to invest, for Africa to grow and to have more public participation in global trade has come. And I think it's a big opportunity for investors to look at Africa quite positively. Our Kenya's performance, going by yesterday's speech, the cabinet secretary said that we've grown by 5.6% in terms of real growth. When we compare with our neighbors, we are quite short in terms of Ethiopia, which is doing quite well at 7%, DRC, Tanzania, Uganda are all ahead of Kenya. But you have to take these numbers with a caution, because it's important to acknowledge that Kenya's economy is much, much larger. But we also need to recognize also that if Kenya's growth does not increase tremendously, we may have a situation in time to come that these economies will be much closer to Kenya. I think we need to be a little bit more proactive. And I know we have lots of protests, a lot of people who are annoyed, individuals and also investors, manufacturers with Kenya's performance and the tax proposals which have come through. But I think we need to look at it positively and see what can be done to make sure that we can improve the Kenya's economic growth. Domestic performance, I think we've last couple of years have been very difficult for Kenya. We went through COVID in the year 2020, 2021. 2022, we had elections, and in Africa, whenever you have elections, the gross domestic production, the economy itself slows down. And last year, we had a lot of global turbulence in terms of financial performance. Our exchange rate actually depreciated by almost 30% from January to December. And of course, interest rates were hiked up. It was quite a difficult situation for everybody. But despite that, getting a 5.6% real growth is quite a good achievement. But the concern is that when you look at the sectors, I think accommodation, which is the hospitality industry, has done well. Kenya itself has attracted a lot of conferences. We've had lots of meetings. The hotels are fully booked. Tourism is back. We're getting almost 2 million tourists a year now. Hotels are also looking good as well at the coast region and also in the Masai Mara. But the key focus is and concern is on the manufacturing side. Our manufacturing is actually declining. And if you look at statistics over the last 10 years, our manufacturing as a contribution towards GDP is actually declining. So are we really competitive? We look at our electricity prices. We need a little bit of stability in our foreign exchange, our interest rate regime. We need more stability in terms of how we raise our taxes, because I think there are just too many changes over the last couple of years. I think investors, foreign direct investors need a little bit more stable environment. I think what is also a big concern for Kenya is that we are not getting as much FDIs as our counterparts in Uganda and Tanzania. I think government has to do a lot of thinking behind the scenes and to understand the root cause and understand why we're not getting that foreign direct investment. There is a huge outcry by manufacturers that we are losing the competitiveness. And to enable us to create employment, I think manufacturing needs to be focused. The private sector is a big contributor to the exchequer. So I think we need a little bit more contribution from the manufacturing. So I think that's the government's think tank. They need to look into that consideration. Other sectors, even construction has been slowing down as well. Arts, performance, and recreation has done excellently well. We have lots of movie productions taking place in Kenya. So I think there's a lot of opportunities that we need to consider. And I think we are all aware that agriculture is one of the biggest contributors to our GDP. And it depends exceptionally also on the weather. Luckily for us, Kenya, we've had good rains over the last couple of months. That has helped us. And that has helped us to bring down inflation as well, which we'll discuss about going forward. Retail price of petroleum products. We're all aware what happened last year. The price of petrol went up. VAT was introduced, additional VAT of 8% was introduced. And again, we also need to acknowledge what's happening in the global economy. We know by 2035, 2040, oil production of motor vehicles will be electric. So we know all these oil producing countries are now diversifying their economies. We should all watch out for what's happening in Saudi Arabia with the hospitality and the investment they're making in other sectors as well. And for doing that, they need a lot of cash. So they're trying to manipulate the oil price. And of course, we all know about the Middle East war and the war between Russia and Ukraine. That also has an impact on the oil price situation as well. So as I mentioned earlier, it's also not only Kenya, Africa itself, we are very, very vulnerable to external factors, which is exchange rates, interest rates, because the dollar is 60% utilized in global trade. So the price of the dollar, the price of petroleum, interest rates globally affects Kenya as well. So that has a huge impact on the economy. Looking at annual inflation, I think we need to give compliment to Central Bank of Kenya, our Governor Thige. I think he's done an excellent job in stabilizing the inflation. We were looking at almost 11.5% in 2017. It's come down to 2018, it came down to 3.7, stabilized between 6 to 7% over the last 3 to 4 years. It went to about 8% in 2023 again, because we had a huge drought, global inflation, exchange rate movement, and I think he's done very well, and we are now within our range of 5%. I think we need to give compliments to Central Bank of Kenya. This is the monthly inflation. Again, I think the inflation really came down from 2024. We will discuss what happened actually in February because of making sure the interest rates were increased tremendously. That has helped us to bring down our inflation. And the main reason of the inflation again being high is because of global inflation. Because you're all aware what happened in the US, UK, and Europe after COVID. UK was giving out furloughs of almost £2,500 every month. The US was dishing out $400 every week. This created a lot of money supply in the market and created a significant amount of inflation, to the extent the UK was looking at almost double digit. So they've all been forced to increase their interest rates, which led to our currency depreciating, because Kenya was very, very slow in increasing the interest rates. We increased our interest rates only from 7 to 10% over a period of 12 months. And here again, reading the same subject, you can see the hike. It was almost 0%. And these numbers are up to June 2023, because they've not increased tremendously after that. And you can see the hike of almost 5% in the US, 4.5% in Europe, in the UK, and 3.75% in Europe. These rates have still been stagnant, and the concern today, as we speak right now, is in the US. Despite these high interest rates, the unemployment levels are reducing. They still were able to create over 200,000 jobs in the month of May. There's been a lot of bets that the Fed will now reduce the rates in the next quarter and the quarter after that. But the bets are now reducing that there might be just a single cut come end of December. So I think these interest rates are important for our exchange rates movement. And only 2 G7 jurisdictions, which is basically in Europe and Canada, have reduced the interest rates. Now, also, it's important to acknowledge that we have elections in the US in November. We have elections in the UK coming in July. We also have elections in France now as well. So I think we need to be wary about what's happening globally as well, because they could have an impact on Kenya's economy going forward. Our interest rates have climbed up tremendously. And again, thanks to Dr. Thige and his team. I think, as I mentioned earlier, I think we were too slow in increasing our interest rates, and I think that was one of the reasons why the currency depreciated. I think it's a simple answer. As an investor, if you are getting 5.5% return on a dollar deposit, why would you want a 10, 11% deposit on a Kenya shilling account? And if you all go by history, what was happening in December and early January, the Kenya shilling was actually depreciating by almost 1% on daily basis. I think this has caused a lot of panic, and increasing the interest rates in the month of February, where now the CPI rate is now about 13%, that has helped for people to cash in on their dollar deposits and move the deposits into bonds and bills and help to release the forex in the market. Now, this slide is very important. One of the key reasons why the Kenya shilling appreciated in the month of February and now, I think it's important to acknowledge that the Kenya shilling has appreciated by 18% from January to May. I think we are the best performing currency in the world. I think it's also important to acknowledge that how things can change rapidly. As I mentioned, that we were 30% down last year, we are 18% up this year. And I think this is the kind of economic policies I think which the government needs to look into. Because as a businessman, I think we need a very stable environment. We can't have significant ups and downs to manage our businesses. So going back to the reasons why our Kenya shilling is appreciated, I think the most important thing is government confidence. I think there was a lot of hue and cry and the media on the government itself, whether we were able to refinance our Eurobond, which was due in June 2024. I think the markets opened up in January, February. Benin and Ivory Coast and other jurisdictions were able to refinance, issue successful Eurobonds. Kenya did the same. We were supposed to have done this in December, but we did this in February. Now the 2 billion which is due in June 2024, we managed to refinance $1.5 billion. Of course, the pricing was a bit higher. We got at more than 10%, but the coupon is 9.75%. That helps to create confidence in the market. That helped to market Kenya successfully, and going forward, the people and the Central Bank of Kenya was quite confident that we should be able to refinance this bond also coming in the June 2024, which is the $500 million remaining. Another important subject to discuss is the infrastructure bond. Of late, we have noticed there's a lot of interest in the infrastructure bond. If you look at the screen, 19th of February, the government wanted only 70 billion. We got 288 billion. Bids was 288 billion, which is a performance rate of almost 412%. But it came at a price. The coupon rate was almost 18.5%. So what had actually happened is a lot of funds came from overseas, and a lot of people again who are holding forex deposits in Kenya liquidated their forex deposits and went back into treasury bills and bonds. That increased the supply in the market, and that has helped us to reduce, and Kenya shilling has appreciated tremendously. Again, it's the same subject where we discussed about earlier, and you can see how the rates have moved. We were almost at 204 shillings in January, and now we're currently at about 167 shillings. Dollar is 133. I understand in the last, or this week rather, the Kenya shilling against the dollar has appreciated to the extent, I think, about 125 and 128. I think time will tell as to how this movement is going to happen going forward. But also, it's important to note that there are expectations that the interest rates in the Western world are going to drop. So I expect also the Kenya shilling to strengthen maybe further, unless we have another shock, external shock coming from elsewhere. I think what is important is, as taxpayers, as investors, as individuals, I think we need to appreciate and understand where the government comes from. And we picked this up from the speech yesterday. And there's always going to be demand for increased expenditure. That means more debt or increase in taxes. But I think the government, the governor, the treasury has to find the right balance. Because our economy is growing. We're now almost 17 to 18 trillion. Population of Kenya by 2040 is expected to be about 90 million, right? So I think there's going to be a lot of pressure on our infrastructure. There's going to be a pressure on government services. There's going to be a lot of pressure on revenue collection as well. I think we need to get the right balance. So the government is telling us, we want all these services. How are we going to fund it? We can only do it two ways. Either we increase the taxes or we increase our debt levels. Now, our president has made very, very clear that he is going to reduce our debt. All right. So what the government has done is they're increasing taxes. Right. Now, whether that will work in the long term or not, that only time will tell us. Because in my opinion, when you look at the Western world, the people of Kenya is the consumers who actually drive the economy of Kenya. And if the disposable income is going to be reduced through higher taxation, it's very unlikely that we're going to get the growth that we aspire. And it's very also unlikely that we will get the tax revenue that we aspire. And going by numbers that have been reported in the media, taxes were increased last year. The Kenya Revenue Authority still has a shortfall of almost 200 to 300 billion Kenyan shillings. So it's not necessary that if you increase your taxes, you're definitely going to get your tax revenue. I think this is an area of concern. This is why people are a little bit concerned as to where the government is heading towards. Allocation, it's almost a 4 trillion budget. And the concern is our interest payments. And that's why where our president comes in, we are spending about 1.2 trillion on interest payment, pensions, and net lending, which is 30% of the total budget. And this is why, again, I repeat, the government is saying, guys, we cannot keep on paying interest. We can utilize that money that we are paying on interest on other areas where we can improve Kenya's economy. And that's why they're increasing the taxes. We can't reduce education, right, which is about 650 odd billion, which is for primary and secondary education. My only concern as a citizen of Kenya is that we are spending 650 billion shillings on educating our people, but we are not able to create employment, number one. Second issue is that we are now exporting our talent to develop the Western world. Diaspora income has now become our #1 foreign exchange earner. Is it the way we are going to develop the Kenya of the future? It's a big question for the government to answer, and I hope we will look into this quite critically. Then, of course, we have energy, of course, infrastructure, which we require. For the first time since we had the new constitution in 2010, our numbers have now hit 400 billion. All the 47 counties are going to get about over 400 billion. The rest of the numbers, the public admin, our jurisdiction, our national security is taking up over 200 billion shillings. So that's where your allocation of almost 4 trillion is going. So I think you should appreciate as to where the numbers are going and why why we are more concerned about the debt rather than improving the collection of taxes, right? Again, the same issue of public sector expenditure, collection and debt. These numbers changed yesterday. The numbers which were in the budget policy statement, which was released in February and March, our fiscal deficit was expected to be about 700 billion, which is between 4 to 5% of our GDP. This has now been reduced to about 300 billion. So you can see every year we are adding between 600 to 700 billion shillings, and that is actually adding to our debt levels. I just wanted to I feel there are a lot of numbers on the screen, but just to simplify the matter, is just to show you and tell you what is the risk to the government when we have foreign debt. We had done the same presentation in last year's budget. And if you look at the numbers of last year, the Eurobond itself, we are looking at about $7.1 billion. And the rate as at 5th of July last year was about 141. We were looking at almost a 300 billion shillings exchange loss, which was unrealized. If you look at the situation as we speak right now, as at 4th June, because of the appreciation of the Kenyan shilling, and we refinanced the 2024 Eurobond debt of the 2 billion, now it's 1.5 billion, which is now 2031. We've actually got an exchange gain of almost 43 billion. So when we look at the exchange loss, overall exchange loss of the debt that we're currently holding is about 124 billion. But we also have to be mindful from an accounts perspective that if you look at the refinanced debt of 1.5 billion, when we got the debt on 24th of June 2014, the rate was about 88 shillings. When we refinanced, the rate was almost 160. So we made a realized forex loss of 108 billion. So when you take the two together, the realized and unrealized loss, we're looking at almost 231 billion Kenya shillings. So that's how vulnerable Kenya is to foreign debt. I think the stability of the Kenya shilling is extremely important, and that's what we are trying to manage. This is the fiscal framework, and the projections are again coming out from the budget policy statement. We expected to collect about 3.4 billion. 3.9 billion is our expenditure. You can see the situation for the domestic interest and the foreign interest that's taking up almost 900 to a billion Kenya shillings. Now, what is interesting is the total financing, as I mentioned, is about 600 billion. Foreign financing is about 333, domestic financing about 263. Now, it's important to acknowledge that the fiscal deficit is going to be 3% of GDP, right, which is extremely low. But it's also important to acknowledge that the target of 3.4 trillion is quite ambitious by the government. If we don't achieve that target, then we could see the fiscal deficit increasing further. Our nominal GDP is expected to grow by between 10 to 12%. Inflation of about 6 to 7%. We're looking at real GDP growth of about 5%. Fiscal deficit, as the government is trying to control the debt, we're going to see it maintained at about 3% of GDP. Interest expense as a revenue, as an expense of total revenue is also going to come down in time to come from 19% to 21%. I think also what's important to acknowledge is the IMF has got a big hand in our budget. I think we are trying to increase our revenue targets. We want to make sure that our revenue targets ratio compared to our GDP comes down and increases to about 21%. As we speak right now, we're hovering at about 15 to 16%. And in the long term, the target is to get to 25%. So don't expect taxes to come down. That is the reality. I think the IMF is basically holding up our government and trying to force it to increase taxes. I think also it's important to acknowledge that the World Bank and the IMF also are not on the same page. If you look at the media reports, the World Bank is not in favor of increasing taxes, because that's going to sway away foreign direct investment, and IMF is actually supporting the current budget. So if the World Bank and IMF are not on the same page, what are we going to do about it going forward? This is our total debt as of June last year. This is 9.6. External is about 54%, internal is 45%. Our big lenders are, of course, China and France. You can see what the US has actually given us, very little. So I'm hoping in time to come, these numbers are going to improve. And of course, we have other jurisdictions. You can look at the other slide. The other section is Kenya's public debt sustainability. I think our target is to get it to 55%. This is what the IMF is trying to get us to. Just a little bit again on our domestic and external debt. We are now 50-50. The reason being because of appreciation of the Kenyan shilling. Our debt is currently sitting at about 10 trillion. 5 trillion is external. Now, 10% devaluation of the Kenyan currency will add 500 billion shillings to Kenya's debt. A 20% devaluation increases it to 1 trillion. Okay. Now, giving a little bit of history, we had a debt anchor of 50%. This is when President Uhuru's Kenyatta's regime. They removed the anchor. They went to a ceiling of 9 trillion. All right, and that is where we really blew out our budget. We were spending more than we were collecting. We increased the 9 trillion to 10 trillion. Right, and when our president came on board, Honorable Ruto, he said we cannot continue doing that. That's why I have a headline there: borrowing cannot keep rising forever without consequences. It is time for governments everywhere to stop making the hard choices. And this is where he comes in and says, guys, we cannot continue to borrow. We need to control this debt. We need to bring the debt under control. And we've come up with a number of 55% of GDP. And this is one of the key reasons why we are keeping on increasing our taxes. And we are trying to control our expenditure as well. I think when we look at the supplementary budgets, the government has cut down the expenditure by almost 200 to 300 billion. There's also on the freeze on recruitment. There's also freeze on salaries as well. So again, there is no doubt that IMF has got a good, big player in the preparation of our budget itself. I think it's also important to acknowledge that it's not only Kenya. I think we should acknowledge that our debt is about 65 to 70% of our GDP. But when you look at the debt levels in the UK, you look at the debt levels in the US, which are more than 100%, to the extent that IMF and now also raised concern that in the long term, that this could become an issue for the US dollar, because reports say that every 100 days, the US debt is increasing by $1 trillion, right? So keep an eye on that, and we will see how it moves forward. I think that's it from me. I think we will now move forward to my colleagues, James, Mudini, and Kevin, to take us through the income tax proposals. Thank you.
Thank you very much, Alpesh, for that detailed discussion on the economic performance of our country. And yeah, we have taken notes on key areas that we need to be aware of. I want to move to the income tax proposals. And in this next section, we are going to look at majority of the tax proposals that have been proposed either by Finance Bill 2024 or through the budget speech. The CS Treasury highlighted some measures through the custom to be gazetted through the East Africa Gazette notice on covering on customs. And key to note is that these tax changes, like the CS mentioned yesterday, are aimed at collecting an additional 346 billion in the financial year 24-25. And in making the speech yesterday, the CS noted that there are various challenges that are being experienced towards realization of that goal of tax mobilization. Some of them including issues to do with technology rollout, hard to tax sectors of the economy, as well as issues to do with the tax planning by taxpayers on some of the areas. So without further ado, let's look at the income tax proposals that have been discussed, that have been provided in the Finance Bill. Remember, the Finance Bill has already been tabled in Parliament. We had a window the last 3 weeks to put forward our memorandum on issues we want to be considered in the public participation process. The Finance and Planning Committee is now compiling their report, which will be tabled in Parliament next week. So the next 2 weeks will be very crucial as we see how Parliament discusses, debates, and makes amendments on various tax statutes that have been recommended in the Finance Bill 2024. Now, we had a discussion around this, so we will not go very much into details, but we just highlight some of the issues that are in the Finance Bill 2024, and which we expect consideration on as a Finance and Committee tables its report in Parliament, and members of Parliament are able to discuss. And on this issue, I think it's important that as Kenyans, we take a keen look on how our members of Parliament are debating and discussing some of these issues, because they have an implication ultimately on the lives of Kenyans. Key to note on this is that the Finance Bill 2024 had intended to expand the definition of royalties, which is subject to withholding tax, to even cover issues to do with the software distribution. And there's also a proposed definition on what constitutes a donation. And we know donations are to tax-exempt organizations are allowable for tax purposes. So you can find that there are a few details on those definitions, which will have a key impact on various tax implementation measures. Now, going on to the next item. Yesterday, the CS Treasury mentioned that the government has noted that multinational entities are continually engaged in tax planning measures that ensure that most of them pay a tax of not more than 15%, or an effective tax of not more than 15%. And he mentioned that there is need to ensure that our tax laws are aligned with international best practice. And in line with this, there has been a proposal through the OECD for the introduction of a minimum top-up tax. And to actualize this, the Finance Bill 2024 proposes to introduce the minimum top-up tax for multinational enterprises that have consolidated revenue of more than 750 million euros. And the minimum top-up tax will be calculated at 15% of the net income, less any combined effective tax rate. There is an elaborate formula on that, which you can refer to us if you feel that this is a proposal that will affect your businesses. Again, on this issue to do with tax avoidance, the Finance Bill 2024 has proposed to repeal the provisions of digital service tax, which is currently payable at the rate of 1.5%, and introduce a new tax called the Significant Economic Presence Tax, which will be payable by non-resident persons deriving income from Kenya through a digital marketplace. A significant shift on this, considering that digital service tax was only introduced in 2021 through Finance Act 2021. It's barely 3 years since the introduction, and we are having a complete overhaul and repeal of the same. And it is important to note that the Significant Economic Presence Tax will have an effective tax rate of 6% of the revenues of the persons who are carrying out business of a digital marketplace. So a significant shift from 1.5% to 6%, and which we have seen so many proposals being forwarded to the Finance and Planning Committee on at least lowering that tax rate on this Significant Economic Presence Tax. To the big or the elephants in the room, as many have said, the last few days of finance bill discussion, it's the issue of motor vehicle circulation tax, which is being proposed at a rate of 2.5% of the value of the vehicle and payable at the time of paying for your insurance. And if you follow the budget speech yesterday, the CS was very, I would say the CS was very categorical that he missed out on saying about the upper limit of the motor vehicle tax, which the finance bill proposes at 100,000 shillings and the lower limit at 5,000 shillings. So it will be an interesting debate and conversation to see even how Parliament will discuss this, because the only amendment that can be passed on this motor vehicle tax as proposed in finance bill can only be carried out either by the departmental committee on their report or on the full house when they debate this tax. We all know that by now we know the implications this will have on the economy in terms of the ripple effects the tax will have on various sectors of the economy. We are talking about motor vehicle tax on critical aspects like public transportation, on commercial vehicles that are being used to transport essential goods and services, and this one will have a huge effect on increasing the cost of living of Kenyans. And we hope the many submissions that have been put forth on this tax will be considered, and it will be interesting to see how the Finance Act will come up with this tax. Another issue that CS talked about yesterday is on introduction of advanced pricing agreements on persons who have related party transactions. And this one will aid in ensuring that people who carry out related party transactions have some form of certainty when they carry out these transactions with their non-resident entities. The finance bill also is trying to repeal some of the tax exemptions that have been there, and this is in line with the medium-term revenue strategy, as well as the national tax policy, which provides for a very minimum level of exemptions from income tax. And some of this we have seen is that the Finance Bill 2024 proposes to repeal the exemptions that have been provided on trust incomes, as well as any exemptions that have been provided on the income of the National Housing Development Fund. So this is aligned to the national tax policy and the medium tax revenue strategy to ensure that we have very minimum exemptions and people are brought into the tax bracket. In line with this, there's also the issue to do with withholding tax, where the finance bill and even the CS Treasury yesterday noted that when you are paying payments to resident persons, there is a threshold of 24,000 shillings that is currently there, and the finance bill proposes to remove that 24,000. So for qualifying payments to resident persons, you withhold tax despite the amounts that you are paying in the month. On issues to do with the capital allowances, just a few proposals around this, particularly to align with the second schedule of the Income Tax Act. There is an issue of diminution allowance, which was introduced in Finance Act 2023 at 100%, and the repeal of the idea of 150% on capital expenditure for bulk storage and handling facilities supporting the SGR operations. I think it's important to talk much more on the employment taxation because this one affects so many of us. And in this finance bill, as well as the budget for 2024-2025, we have seen at least some few measures or tax measures that are aimed at cushioning the employees from the high cost of living. But if you look keenly at some of these tax measures, it feels like the government is giving on one hand and taking on the other, because some of them, maybe if you look at the ultimate effects, it will leave you at a worse position than even you were before. But some of the notable changes that are intended to be introduced by Finance Bill 2024 is that there is an increase in the threshold of meal benefit by the employer to the employee from the current 48,000 shillings to 60,000 shillings, per diem allowance from 2,000 shillings to 5% of the monthly gross earnings, and also on the allowable non-cash benefits, there's a proposal to increase it from 36,000 shillings to 48,000 shillings per annum. There's also a proposal on the allowable contribution to for pension from the current 240,000 shillings to 360,000 shillings. So some of these proposals are aimed at cushioning the employees from the high cost of living, which has been evident in the last few years. Again, on this, there is also a proposal to bring some expenses that are, or some deductions that are being levied on the employee to be allowable deductions for tax purposes. These include the affordable housing levy contributions, the shift contributions, which, as we have been told, is supposed to kick off from July 2024, as well as mortgage interest relief being increased from 360,000 to 360,000 shillings per annum. Now, this is where we are saying that some of these proposals, like the shift is coming at the rate of 2.75%, but it feels like the government wants to perhaps try and cushion employees by providing that contribution to be allowable. But on the other hand, the 2.75% would be a huge cost to many employees against an income level that is not increasing on a year-on-year basis. A few proposed changes on the withholding tax regime, and when the CS talked about expanding the tax base and covering people who have earlier on not been brought in the tax base, I think he was trying to allude to some of these measures that are being proposed in Finance Bill 2024. The first one being the withholding tax on persons who supply goods to a public entity or to government and government agencies. The withholding tax will be at the rate of 3% for resident persons and 5% for non-resident persons. And this will bring people who have been supplying to the government, noting that the government is the largest spender, is the largest purchaser of goods and services in the economy, and people who are doing business with the government will now, at least the government would have, or the KRA will have some visibility on the level of income that they are generating, and they will be able to ensure that those people are brought into the tax net. Again, also on withholding tax, we know that for the longest time, infrastructure boards have been exempt from taxation, which created a lot of disproportions, because if you look at people who even invest in these infrastructure bonds, are people who are able to put in the amounts that are put at the threshold of 50,000 shillings. Now, having those people not paying taxes on that income has created a lot of disproportion, and the government has proposed to introduce a withholding tax of 5% on the interest income that is earned from infrastructure bonds from 1st July 2024. So any infrastructure bond that would be floated from 1st July 2024 will attract withholding tax at the rate of 5%. On the issue of capital gains tax, There's a proposal to try and attract, especially the private equity enterprises and the venture capital enterprises from other jurisdictions such as Mauritius, and trying to bring them into Kenya. And to this end, there is a proposal to have a lower CGT rate of 5% on the gains that are made from the transfer of investment by persons who are incorporated through the Nairobi International Financial Center Authority. And this will at least try and bring some of these organizations that have been putting the investment structures outside Kenya in the BVIs in Mauritius, and try to bring them in the country and through that exemption that is provided for CGT. On tax administration, there have been a few changes that are being proposed through Finance Bill 2024, covering the Tax Procedures Act. The Tax Procedures Act is the main statute that deals with the regulations and measures that are aimed at tax administration for the various tax statutes. Here we are talking about the Income Tax Act, VAT, Excise Duty, and the Miscellaneous Fees and Levies Act. All their administration is all covered under the Tax Procedures Act. The notable changes through the Tax Procedures Act include the repeal of any withholding VAT exemptions that have been provided earlier on. So going forward, withholding VAT will be applicable on all taxable supplies, including zero-rated supplies. Again, there is also a proposal that which would require the KRA to request taxpayers or to write to taxpayers requiring them to integrate their systems or their tax systems with the KRA system. And this will give the taxman increased visibility of their operations in terms of their invoicing, their stock levels, and so forth. And in line with this, it's also key to note that there has been a very punitive penalty that has been proposed for failure to comply with the integration, pegged at 2 million shillings for every month that you remain non-compliant. And in line with this, we can see that the government, through the Kenya Revenue Authority, is trying to adopt technology to ensure or to ease in tax administration and collection of taxes in the country. Some other changes in line on the Tax Procedures Act include that the timeline for objection decision will be increased from the current 60 days to 90 days. And something which the CS Treasury mentioned yesterday is that where the commissioner issues you with an urgency notice where you owe money to a taxpayer and you are required to first pay the Kenya Revenue Authority before you pay that taxpayer who is in default, that agency notice will be valid for a period of 1 year. There is also a proposed reintroduction of the powers of the commissioner through the cabinet secretary to abandon any taxes where there is difficulty in collecting those taxes. And I think this one was repealed through Finance Act 2023, and we have seen the government trying to abandon some of the taxes, notably owed to by the sugar industry, and there was no enabling legislation. So we feel that this is a proposal that is aimed at enabling the government carry out those abandonments where they feel that it's very difficult to collect those taxes. Some other changes of the Tax Procedures Act include nationalization of the penalties levied on an export processing zone entity for failure to file a return. Currently, it's at 2,000 shillings per day, and it's supposed to be nationalized to at least 20,000 shillings per month outstanding. And when we come to tax refunds, the application for an offset or refund of overpaid income tax will be made within 5 years from when that tax was due. And for all other taxes, this is VAT and excise duty, that application should be made within 6 months if the Finance Bill 2024 is amended as it is. So those are some of the notable changes on the income tax and the Tax Procedures Act. I'll now hand over to James for the indirect taxes changes that have been proposed in Finance Bill 2024. Thank you, Kevin, for that elaborate session as well as the page. And I believe up to this point, we've been able to keep you abreast with what to expect come the end of the month when we receive the Finance Act 2024. So we'll quickly look at the proposed VAT changes. And what I'd like to note from the onset is that from the budget statement yesterday by the CS, there was really no variation between what is in the finance bill and what the few points that he mentioned. But then we'll just quickly brush through on what we expect to see come the end of the month. The CS mentioned something on basically the VAT registration threshold, which there is an intention to increase it from 5 million to 8 million shillings annual turnover. So we shall expect to see if that comes through. The issue of clarification on the tax point for exportation of goods still is the case, where you need to have the proper export documentation before that sale can be considered to be an export. The issue of tax invoices and the e-teams initiative, the definition of that is just to make sure that there's alignment with the Tax Procedures Act on matters pertaining to valid tax invoices for VAT purposes. Then we also have the issue of the apportionment of input VAT. And I think the proposal basically is just to make sure that input VAT is only claimed on taxable supplies. So the 90%, 10% apportionment formula is proposed to be done away with. A very peculiar proposal, the issue of the VAT withholding credits. I think the first notable proposal is that there will no longer be VAT refunds that are resulting from excess input as a result of VAT withholding. And what they are proposing is that before any taxpayer can actually take advantage of a VAT withholding credit, it will be verified. We don't know how KRA will be able to really achieve that. Then assuming you receive a refund of VAT on bad debts, currently you have a period of 60 days to make sure that you refund that money back to the commissioner, assuming you recover the debt. There's a proposal to actually reduce that time frame to 30 days. If we move along, something else that the CS in his budget statement alluded to is a review of the exemptions and zero rating status of various products to try and reduce the number of items that are either zero rated or exempt from VAT. And I think the table that you can see on the screen is a manifestation of that statement. It is actually funny that the CS never mentioned anything on the very first item, the issue of ordinary bread. We know the politics that will go around that. But I think that's one of the proposals we see as a carrot that will be dangled to justify some form of review was done on the finance bill. I think for those of us who are doing a lot of business restructurings, the issue of exempting transfer of business as going concern transactions, exempting them from VAT is a welcome move, because at the end of the day, you find that a lot of these restructurings are happening within a group, and there's actually no need for group operations to actually incur a VAT cost. Something funny, which is sort of not aligned to the emphasis by the government on climate-related issues, is the issue of subjecting to VAT e-mobility. And basically this touches on electric bicycles, electric motorcycles, as well as electric buses. There's a proposal to make these subject to VAT at 16%. And then I think one of the comments by the CS of transport was that he's not aligned with this proposal to introduce VAT, because then it sort of reverses the gains that are geared towards promoting the transportation sector from an e-mobility perspective.
Then I think another notable proposal, which will have far-reaching ramifications, is the issue of subjecting to VAT certain financial services as well as insurance services. We already are grappling with the challenge that will be faced with the motor vehicle circulation tax. You can now imagine what that, for example, will have in terms of the negative impacts to the insurance sector. If we move along, you'll also notice that there are certain other proposals on this particular slide, some that are even touching on the tourism sector, where there's a proposal to introduce VAT on these special, basically specially designed locally assembled vehicles. And you can actually see some of these proposals are actually sort of counterproductive. It's also funny for them to propose to introduce VAT, and this touches on the healthcare sector, on the exemptions that have always existed on taxable goods and services that are used for basically the construction and equipping of hospitals. If we move along, the supply of motorcycles, which is currently zero-rated, is proposed to be exempt. And I believe we all know the impact of exemption basically means it does not necessarily result in a reduction in VAT. A lot of any input VAT that would have been incurred on purchases then would have to be an absorbed cost, resulting in an increase in the price of these commodities ultimately. I think I've mentioned something on the tourism sector. You can see the last bullet. Anything relating to tourism facilities, recreational parks, there's a proposal to introduce VAT at the rate of 16%. I think on this last slide, I think I've touched on the issue of e-mobility. There's the issue of the impact to the agricultural sector. Currently, agricultural pest control products, as well as any inputs that are used to manufacture these products, are currently zero-rated, and there's a proposal to make these exempt. And then that obviously will come with a price escalation, which is not a good thing to agriculture, which is actually a biggest contributor to the Kenyan GDP as well as employment. So I think that marks the end of the VAT proposals. And more or less, we did not pick anything from the budget statement that would differ from what is in the finance bill. And we shall just have to wait and see what comes in after the parliament has actually debated the Finance and Planning Committee report to see what is finally enacted into law. So we shall quickly also look at excise duty and customs proposed changes. Similarly, from an excise duty perspective, there was no notable change from the CS's budget statement. And I think there was emphasis on the very first item, where any accessible services that are being offered by a non-resident through a digital platform will be subject to excise duty in Kenya. And I think this will take more or less the same form and manner where non-residents are actually providing digital services to Kenya, where they're required to account for VAT. So there will be a similar requirement to do that. The other issue is the issue of advertisements over the internet that are touching on betting and gaming and alcoholic beverages. This is just an alignment. The excise duty currently on such adverts is only through the mainstream media, but they want to align and make sure that any such adverts that are being done over the internet or social media are also subject to excise duty. I think the issue of the vegetable oil is a critical one. The proposed introduction of excise duty at the rate of 25%. But then if you look at that proposal, coupled with the proposal to also introduce excise duty at the rate of 10% on locally manufactured articles of plastic, you can actually see the price implication that will have on that particular product overall. So I think those are more or less the larger issues on that particular slide. Then if we move along, proposed excise duty increases. I think the betting and gaming industry is always a casualty every budget cycle. So there's a proposal to increase the excise duty from 12.5% to 20%. Then the issue of telephone and internet data services, as well as money transfer services. There's a proposal to increase the excise duty by 5%. But then there is that proposed retention rate of 15% of excise duty on money transfer services by mobile cellular phone providers or payment service providers. If we move on, I won't belabor so much on this slide, but this is just an indication as to the proposals that are in the finance bill on an increase in various excise duty rates for various products. I was actually following people's comments on X yesterday night after the budget statement, and the fans or the fanatics of vapes were up in arms, and you can see liquid nicotine for electronic cigarettes. There's a proposal to increase that, and they seemed to be the population that was grossly affected by some of the increases in the excise duty. There is actually a very welcome proposal on particular agricultural products that originate from the EAC, where there is actually a proposal to exempt them from excise duty. And this is largely imported eggs, imported potatoes, as well as imported cartons. I think this is a welcome move just to foster and grow trade within the East African community customs territory. There are other items that are actually proposed, and there is actually a proposal to exempt imported clinker from excise duty. This will obviously enable or rather make any ventures into the construction sector cheaper by just making sure that the prices of cement are within control. I think the other notable item on this slide is there was a cleanup of the legislation. If you might recall, the commissioner had some discretionary powers to adjust excise duty rates due to inflation. Those powers were taken away by the Finance Act 2023, but then there was a drafting oversight in the Finance Act 2023 that has been cleaned up. I think those are largely the items of focus on this particular slide. If we move along, the other issue actually that the CS started by touching on yesterday was on the issue of anticipated customs changes. And you have to note that any customs related changes normally are not contained in the finance bill. And this is because all customs matters within EAC are legislated under the East African Community Customs Management Act. We expect to receive the EAC Gazette notice by the 30th of June, which will have more elaborate amendments from a customs point of view. But what you will generally note on this slide is that Kenya had made various requests for either stay applications of duty rates or extension of remissions on certain items. And actually a majority of these requests were met. And a good example is like on the issue of imported rice, there was actually a request for stay of application of import duty rate of 35% or USD 200,000 per metric ton for a further 1 year, and that request was granted. So I will not necessarily go through each of the items. We will do a separate alert once we receive the Gazette notice on sector-specific items, which will be of interest to the different sectors once the EAC Gazette notice is published by the 30th of June 2024. So at this point, I will hand over to my colleague Kevin so that he can take us through the miscellaneous fees and levies act and other proposed changes in the bill and the budget statement.
Thank you, James. moving to the miscellaneous is a levies act. There have been some changes that were proposed by Finance Bill 2024, which the notable ones is that there is a proposal to increase the import declaration fee from 2.5% to 3%. Remember, it's only last year that the rate was brought down from 3.5% to 2.5%. And again, there is a new tax. I think every year we are seeing a new tax or a new form of tax being introduced. This year around is what we are calling an environmental tax, or the eco levy, that will be levied on specific goods manufactured or imported into the country. And we'll see in the subsequent slides some of the goods that the eco levy is supposed to cover. Last year, there was an introduction of an export and investment promotion levy, and which we really queried on its mandate, because it's being called an export levy, but it's really being levied on items that are being imported into the country. The rate was at a very high rate of 17.5% for some of the items. We have seen a proposal in the Finance Bill 2024 to lower that rate to a high of 10% and on most items to be at 3%. And what we understood was the purpose of this levy was supposed to promote investment in certain sectors of the economy and discourage importation of items that can be produced locally. So those are some of the items that are covered by the Export and Investment Promotion Levy and the proposed rate through Finance Bill 2024. I think that slide also forms a continuation of some of the items that will be subject to the Export and Investment Promotion Levy, principally at the point of importation of these goods. We will pay the levy at the rate of 3% of the customs value of those items. I mentioned about the environmental tax or the eco levy, which is being introduced through Finance Bill 2024, and it's supposed to pay for the adverse environmental effects of certain products, whether locally produced or imported into the country. And these items include items like diapers, batteries, rubber tires, and so forth. And we noted some weaknesses in this tax, to the extent that it's being called a levy, but there is no enabling legislation to ensure that the amounts that are being collected from this levy are ring-fenced in a fund that will go towards paying for those adverse environmental effects. Because if you are being taxed because you are of the environmental effects, then those monies need to go to activities that are aimed at curbing those harmful effects on the environment of those items. And you see that this tax will be applicable on items like our basic items that we feel maybe do not have a very huge impact on the environment, but some of them, yes, may have an impact on the environment. So we hope to see some regulations being provided, and not only regulations, enabling legislations to add this to ensure that we are not being taxed on items like diapers and plastic packaging materials, and that money goes towards maybe paying of salaries and so forth. It should be channeled towards environmental mitigating projects in the country. Some other proposed miscellaneous changes. The notable one is that there's a proposal to exempt the Kenya Revenue Authority or the Commissioner from complying with the provisions of Data Protection Act, especially in requesting for personal information, where they feel the Kenya Revenue Authority feels that that information will be essential in tax administration. I think this is a proposal we have put forth our submissions, that we know the implications and the serious implications it can have when personal data is not handled in line with the principles provided in the Data Protection Act. And we hope that the Parliament will consider our proposal and ensure that nobody is exempted from the provisions of Data Protection Act, especially in today's age where there is a lot of issues to do with how data is being handled. There were some other proposals that we were able to pick from the budget speech that will have maybe some impact in terms of various operations of various sectors in the economy. And the first one is that the CS mentioned that there is a new policy implementation framework that has been put in place that ensures that our interest rates or there's an establishment of an interest rate corridor that is pegged on the targeted inflation for the country. Remember, Kenya operates a targeted inflation methodology where our inflation rate is supposed to be at 5% plus or minus 2.5%. And we have seen the Central Bank of Kenya always put measures where that rate goes beyond that targeted rate. And what is happening is that the new policy will ensure that the interbank rate that is provided is within the rate or the interest rate corridor that will be pegged on the inflation targeted. Last year or late last year, there was an introduction of what we call the DAO CSD, which is a simplified platform to ensure that common persons are able to have access to investment in treasury bonds and treasury bills. And it's a very straightforward platform, which at the comfort of your office or your house, you can be able to put investments into the treasury bonds and bills once they are floated. And the government is trying to push that forward to ensure that as many people as possible are able to be able to invest in treasury bills and bonds. The Treasury CS also mentioned yesterday that there is a planned introduction of a platform where you can invest as low as 600 shillings in treasury bonds and bills. There is also, the Treasury CS also mentioned that there is need to ensure that the banking sector is protected and is in line with the global best practice. And in line with this, there is a proposal to progressively increase the core capital for banks from the current 1 million shillings to around 10 million shillings. And when we were looking at this proposal, as much as the CS talked about it being introduced progressively, and there being consultations with the banking sector to ensure that the timeline for these proposals are aligned, we noted that if you currently look at the banking sector, less than 38% of the banks have a core capital of more than 10 million shillings. And you can see the impact this will have on the sector. It may force some banking organizations to merge and or to have some consolidation. But much more of this, it tends to lock out maybe some banking organizations that are developing in the country. Let's say some microfinance organizations that will want to transition to a fully fledged bank will be locked out because of the huge core capital of 10 billion shillings that will be required for you to be issued by a license by the Central Bank of Kenya. And also key to note is that not so many people can put such an amount in one single business. And this will have a serious effect in terms of also limiting the number of banking institutions that are available in the country. Again, in March 2024, the CBK issued what we call the Green Finance Taxonomy, which is supposed to provide guidance to the banking industry on investments that are towards the mitigating effects of climate change and environmentally positive projects in the country. Also, there is a proposal to amend the Banking Act to provide for steep penalties that are proportionate to the violations that are being committed and that are pegged on the Banking Act. On the insurance sector, the CS noted in his budget speech yesterday that there is need to review the Insurance Act. It's quite important to note that the current Insurance Act has been in place for the last almost 40 years. I think it was as assented in 1984 and has had very minimal amendments and is currently enacted. It has also very punitive penalties that lock out so many people out of the insurance sector. And to try and ensure that there is insurance penetration in the country, the CS noted that there is need to review and possibly repeal or amend the current insurance act to ensure that it also fosters insurance penetration in the country. And in line with that, the CS also noted that the Insurance Professionals Bill 2024 is under review, and the main purpose of this bill is to ensure that it strengthens and improves the stability of the performance of the insurance sector in the country. Now, the CS also noted yesterday that there is a planned investment in certain sectors of the economy, which the government feels that they have a huge impact, especially in improving the livelihoods of Kenyans. And this is what the CS called targeted sectors. And these include the leather and industry products, the textile and apparel, the blue economy, as well as the construction of building materials. And there is supposed to be enhanced investment as well as policies to ensure that these targeted sectors are being facilitated for economic recovery and growth. But then as we are looking at this, we also noted that edible oils was also part of this. And we are asking ourselves, the government wants to stimulate this industry, say the edible oils industry, but then you look at the fiscal measures that are being put or the taxation measures that are being put, they are not aligned with that targeted recovery of this sector. When you go ahead and introduce excise duty at the rate of 25% on edible oils, like James mentioned earlier on, then that will have detrimental effects, and it's not a measure that is aimed at stimulating this sector towards economic recovery and growth. So there is a misalignment of some of these policies between the fiscal or the tax measure, as well as what government intends to undertake in terms of the economic recovery and growth of these sectors. The other notable proposals the CS noted is that there is need to migrate to accrual accounting for government and government organization, as well as the county government. And important to note is that whereas so many organizations, all other organizations, including the organizations we work for, have always maintained their financial accounts on an accrual concept. The government has lagged behind and has always maintained its account on a cash basis, which is not prudent in terms of financial management, because there is really no stock that is taken of what the government owes as the asset, as well as what the government owes to people in terms of pending bills. And this is what we have seen there being a huge portion of pending bills in the country. So the CS in his speech yesterday noted that the last year where the government and government organizations will prepare their accounts on a cash basis is financial year 2023-2024, which ends this year or this month in June. And from 1st July 2024, all government organizations are supposed to migrate to accrual concepts of accounting. And it's important to know that over 65% of countries globally have already migrated to accrual accounting. So there is need to ensure that Kenya does not lag behind on that. And accrual accounting will also ensure that there is prudent financial management of government and government organization funds. And the government will also be able to take stock of any pending items, all the assets that are owned by the government, and so forth. Again, on in line with the accrual accounting, you recall that the Public Finance Management Act, which was enacted around 2012, provided for the establishment of a single treasury account, whereby the government will have one bank account maintained at the Central Bank of Kenya, and all government organizations will be required to bank with that. The CS noted in his budget speech yesterday that when they did a survey in 2023, is at the end of June 2023, there was about 431 billion shillings held in various bank accounts by various government organizations. And the CS noted that when the government really needed that money, they could not have access to it. And you can tell that maybe would have come in hand or would have been very important, especially during the repayment of items like the Eurobond. So come 1st July 2024, the CS noted that the Treasury will adopt the issue of a Treasury single account, where all government agencies and the government itself will operate that single account at the central bank. And it's important to know that we have some jurisdictions that have already adopted this. Closer home, we have Nigeria, which adopted the single treasury account as of 2016, albeit with some challenges, but it also brings about a lot of prudent management of government resources and government finances, and it ensures that there are no duplication of roles. And when the government would need that money, they would have an easy access to it. That brings us to the end of that discussion on the proposed changes on the Finance Bill 2024. As earlier mentioned, the next steps in terms of Finance Bill 2024 is that the Finance and Planning Committee will table its report this coming week. Any amendments, any changes will be brought to the floor of the House. And by 30th of June this month, the Finance Bill should be assented into law by the President. And come July 1st of July 2024, many of the changes will take into effect. And as always, we will have a detailed analysis of the changes that are coming through the Finance Act 2024, as well as engage you in a seminar to discuss the changes and the impact those changes will have on our economy. At this juncture, I want to hand over back to Michael to moderate on the Q&As or the questions that you have posted to our chat session. Back to you, Michael.
Right. Thank you, Kevin. I think I really want to thank the panelists. That's Kevin, James, and Ampesh. They have done it so well. So we have a few questions that have come through, and I will start with you, Ampesh. And the first question is on the forex rates. And the question is, what do you think is the outlook to the end of 2024? How is the forex going to be the Kenya shilling?
Yeah, I think as I mentioned earlier, Kenya shilling is appreciated by 18%. And the outlook in the global economies is that the interest rates have to go down. US will take a little bit of time. So it is in the UK. Universal interest rate cuts in Europe and Canada. If there are no other external factors, I think we should see the Kenya shilling stabilizing between 128 to 135. And I think that's the way it should be, because I think in terms of also bonds, there's a lot of interest as well from overseas in investment into our treasury bills and bonds. There's also a lot of interest into the Nairobi Stock Exchange. So there's a lot of inflows coming in, and also tourism is also picking up, agriculture is also picking up. So in terms of managing the forex balances, the reserves, I think we should be okay. That's why, unless we have another major shock coming down.
Okay, thank you very much, Alpesh, for that. And the next question to you, Alpesh, is on the manufacturing sector. And in your analysis, you showed that this sector has been declining in terms of the performance, in contribution to the GDP over the last couple of years. And the question is, what do you think the government should have done better to prop up this industry, which is no doubt very important for the overall growth of our economy? What do you think the government should have done, Alpesh?
I think the government basically, I think they need to do a root cause analysis. I think listening to a lot of manufacturers, I think we are not competitive. I think cost of doing business in Kenya is increasing day by day. Our cost of power is extremely expensive. And I think when we compare ourselves to South Africa, and Egypt, and I think that an infrastructure as well. I don't think we have the right infrastructure. I don't think we have the right environment. We need stability in our financial markets. We can't have the exchange rates moving up and down the way it has been moving over the last 18 to 24 months. Interest rates. Our interest rates are too high. You can't conduct your business paying interest of 18 to 20%. The cost of borrowing in this country is just too high. And again, that comes back to government deficit. That's what the government is trying to do. But again, government has to maintain their expenses. They have to look after revenues. They have to bring in efficiencies. And to be honest, over the last couple of years, I think there have been too many changes in the legislation. I feel there's been too much changes in the taxes as well. I think it's going to confuse people. And I think we will have additional people on board just to comply with all this. I think there are lots of other factors as well. But I think they need to identify the root cause analysis, and I think a lot of manufacturers are not happy about it. Another important message is there are lots of goods coming into the country. A lot of people who are not paying duties. I think we need to get them into the tax net so that we can have a competitive environment. Because manufacturers who are doing things officially are not going to be able to compete with those who are not doing business the illegal way.
And thank you for that question. The next question is to you, Kevin. And this is on the administrative burden. Someone is concerned that there are too many taxes that have been introduced over a short duration of time. You have taxes that must be remitted within 5 working days. I think some within 24 hours, like the betting industry. And the question is, what do you think this is going to do to the taxpayers who are willing to comply? But then this creates a lot of, extra work for them. Kevin.
Thank you, Michael, for that question. And it's important to note that even the Treasury CS himself noted that one of the challenges we have as a country towards attainment of the level of the intended tax collections are issues to do with tax administration. And on tax administration, you also mentioned that there are so many tax changes that have come in place over the last few years, which many people are not able to comply with. I think what happens is that you introduce so many of these taxes at a go, it results to people being not compliant on some of these taxes. Some of these taxes are very punitive. It does not lead to the intended goal of what we intended to collect, because like the question we were asking ourselves last year, what we would want to see what difference the remittance of withholding taxes by the 20th of the following month and changing it to within 5 days has brought about in terms of tax collection. Is it just a timing issue and there is no significant increase in the tax collection? But again, on the other end, it results to an administrative burden on taxpayers. And on that issue, Michael, it's critical to note that towards end of last month, the Treasury published the National Tax Policy. And the National Tax Policy is supposed to guide on the policy changes that are supposed to be taken on tax laws. And one of the issues to be noted is that tax changes need to have a certain duration before you can introduce a new tax change. And the National Tax Policy mentions about a period of 5 years within which you can make changes on the tax laws. I think it's about time we start implementing that to ensure that we don't have changes that are coming in, year out, which even ourselves as tax practitioners, we are not able to even keep aligned to some of those changes.
Thank you, Kevin. While at it, kindly expound a little more on the top-up tax and the advanced pricing agreements. You just clarify a little bit. There's someone who has a concern on that.
Okay. Yeah. Okay. So the minimum top-up tax is supposed to only cover multinational entities that have an income threshold of more than 750 million euros in a year. And what the income, the proposal is targeted is that as a multinational, you'll be able to compute if your effective tax rate is within the rate that is provided for income tax. And based on the formula that is provided, there will be a minimum top-up tax of 15% to be levied by those multinational enterprises that don't meet that threshold. So what the CS was alluding to is that entities who are doing especially cross-border transactions do a lot of tax planning to ensure that their effective tax rate, as much as they are doing business in different jurisdictions, remains as low as possible. And to harmonize that is what has necessitated the introduction of a minimum top-up tax. I think these are conversations that is not only emanating in Kenya, but is also a global conversation to ensure that multinational enterprises pay their fair share of tax. On the advanced pricing arrangements or agreements for that matter, what happens to that is that as a taxpayer, if you have cross-border transactions with the APAs or the advanced pricing arrangements, you can prepare your transfer pricing documentation. You go ahead to the commissioner or to the Kenya Revenue Authority, you tell them that this is how I've structured my related party transactions. This is my transfer pricing methodology. Are you agreeable to it? And if the taxman reviews it and says that they are okay with it, then it gives you some level of comfort for the next 5 years that the Kenya Revenue Authority cannot come and go against what they gave you as the agreement in terms of the APA. What they can only look at is, are you in line with what was agreed? And that will provide a lot of certainty to taxpayers who have those border transactions, where we have been seeing that this year the Kenya Revenue Authority will come and do an audit and say that no, you are supposed to do or to use this methodology and apply it. The next year or the next time the Kenya Revenue, a different team comes for an audit, they want to apply a different methodology. So this one, if well enacted with enabling legislation or regulations, it will provide a lot of certainty and comfort to persons who have cross-border transactions.
All right, and the next question, James, is yours on the taxation of insurance. And the question here is, what we discussed, is it about taxing the premiums or is it the claims?
Yeah, thank you, Michael, for that question. What you'll note with the current provisions, the first schedule to the VAT Act has listed financial services as well as insurance and reinsurance services in totality as VAT exempt supplies. So what that basically means, for any financial service that you receive and of any nature or insurance service that you receive, you are not charged VAT by the insurance company or the financial institution. Now, the proposal is that there are certain financial services and there are certain insurance and reinsurance services that will be subject to VAT at the rate of 16%. Now, if I was to split out the two service categories, for financial services, for services like any charges relating to the issuance of debit and credit cards will be subject to VAT. Any check handling and issuance charges or cancellation of checks, any such charges that we incur will be subject to VAT. So there is a listing of those particular financial services as is currently listed in the first schedule that will be subject to VAT. When we go to the insurance and reinsurance services side, the only aspects of insurance and reinsurance that will not be subject to VAT are the premiums. The rest of the services in insurance, whether it relates to valuation, whether it relates to actuarial services that you receive as part of that, any management or consultancy related to the insurance product, all those will be subject to VAT at the rate of 16%. So that basically means look forward to an increase in these financial services or insurance services. And the question is that, what then does that mean to the uptake of these products? Already looking at, for example, the insurance products, I think the uptake of the product is not that much. So an increase in that price, then also coupled with the introduction of this motor vehicle tax, you can imagine how much taxpayers or businesses will have to grapple with in terms of increased costs every year.
Thank you, James. And I think the last question is directed to me. And I think it's more of a comment, actually. It is asking, as the government pushed taxpayers to such an extent that we will now see active tax avoidance or non-compliance. I think no straight answer to that, but just to say that when you push people so much with multiple taxes, obviously you will get them thinking on how they can try to avoid some of the taxes, but within the legal frame. One of the things that is likely to happen, and we've seen that from last year, they increased all these taxes, but the KRA has missed its collection target by almost 300 billion. So it does not mean by introducing so many taxes, you are going to, the same way you are going to collect the taxes. And I want to give a good example, the motor vehicle circulation tax. What's going to be the impact of this? You can imagine, and I want to believe it is not true that they have removed the cap, because according to the CS yesterday, he never talked about the capping to 100,000 shillings. So if someone has a vehicle worth 15 million shillings, for example, you approximately will have to part with 400,000 every year on this motor vehicle, additional to the 3.25% or 3.5 or 3.75% comprehensive insurance. So if I have to keep this vehicle on the road, it means I am spending almost 800 or 900,000 per annum to keep my car on the road. But I need the car to come to work or to, to go about my own businesses. So what's likely to happen? It's possible that I might decide, because the motor vehicle circulation tax is mandatory, I would pay that and put my vehicle on third party. What will I have done? Effectively, I will have denied the insurance company their fair share, which then the government is also losing that % income tax on that. That insurance company is going to send people home. That pay-as-you-earn is going to be lost. There's a cascading effect to this. And it is easy for the government to introduce taxes, but sometimes they don't see it to look at the ripple effect. What is it going to do on the cascading effects of that? That's a very good example that the insurance sector is going to be deprived of income. If they are deprived of income, they have no income tax to pay government at 30%. Pay as you earn, they are going to send away people. And ideally, this is some of these taxes, this is exactly what they are doing, including the affordable housing levy. So people will find a way. And I can tell you, for the first time, it is very evident that people who always wanted to comply with the taxes are asking for tax planning measures that can help them survive, because these taxes are ending up suffocating all of us. So very finally, before I give the gentleman here a chance to say their parting shots, I just want to read one of the comments which has come from one of the participants, and I'm not asking for a response to this, but I think it really caps it all. And the participant is saying, listening to all this, I feel like I am hearing European politicians creating bureaucracy, but not measures to support growth of the economy, to provide prosperity to the Kenyan people. Poleni sana. That is a comment which has come through and is an interesting comment, and I think it really caps it all. So Alpesh, starting with you, maybe your parting shot, then James and Kevin in that order.
Yeah, thank you, Michael. I think that's a very interesting comment. I think, for me, I think the government is hellbound on debt reduction. They're targeting a 55% ratio as fast as possible. And they want to make sure that the tax revenue to GDP is at 25%. Whenever you prepare any budget, I think we need to take it long term. I think the measures that we have put in place are very short term. Now they're going to have major repercussions on the economy, on the industries, and the people of Kenya. When you start taking away disposable income you will not get growth in the economy. So I think this is an area I think the government and the treasury needs to look at it very, very critically. I think we need to increase our revenue by increasing the growth of Kenya itself. Another important message is that we only file 6 to 7 million tax returns in the country. 6 to 7 million tax returns cannot support a population of 55 million people. And that's the reason why we feel that we are getting overtaxed. We are going after people who got the money. Look at all the taxation measures. We're going after the motor vehicle circulation tax. Look at the cost of doing business in Kenya. You just do a bank transfer, you could get excise duty of 20%, VAT of 16%. So all our needs, basic needs are going to be taxed. Bread, bank transfers, debit cards, credit cards, housing levy, SHI of 2.75% uncapped. All this is going to hit the disposable income. If we had elections next year, this bill would not have passed or may not pass. I think we will suffer for the next 2 years. As I said, and I repeat, the government is hellbound to reduce debt, is hellbound to increase our tax revenue to GDP, getting closer to the 25%, which is going to be very tough for us.
James?
Yeah, thank you, Michael. Mine is a concern with the whole public participation aspect. Unfortunately, my view is that this is an exercise that is just supposed to tick a box. It's an exercise in futility, and it is an exercise to waste the public's time. And this comes from a view and a perception that has been created by those who had an opportunity to attend these functions. And you notice that there's already a predetermined conclusion to the entire exercise. And you see when sentiments and comments are being made that this and that has to go through, then you ask yourself at the end of the day, what was the purpose or what was the intention of that exercise in the first place? So it's more, in my view, it's more of an integrity issue on the side of the government. If indeed they are genuine, to invite the public to give views, this is a process that should even begin by involving key stakeholders. And a good example is if there is a sector that is hard done by this finance bill 2024 is the manufacturing sector. It is only fair that the stakeholders in the manufacturing sector, for example, give their views before the finance bill is even published. It is only then that the government can be able to come up with proper proposals that, number one, will spur the different sectors. And number two, they will also get ideas on where they can be able to collect extra revenue. So I think from an integrity point of view, that entire process is flawed and is an area that the government keenly needs to look at if there is any sort of fruitful outcome that is expected in any future budgets. So thank you, Michael.
Yeah, Chairman.
Thank you, Michael. My parting shot is that I feel there is need for the government to carry out empirical studies on new tax measures that they would want to introduce or increase any taxes to ensure that they are able to look at the opportunity cost that comes with that introduction of a particular tax. Like you have mentioned, Mike, we will see very huge effects, not only in the insurance sector, but in so many sectors of the economy with just the introduction of one tax, the motor vehicle circulation tax. Again, an introduction of something like excise duty on vegetable oil will have very huge effects on the economy. I think there is need to carry out those empirical studies. The government have enough resources to carry out so that decisions that are made are being anchored on some empirical studies to demonstrate that, yes, we want to take this, but are we able to do this? It is also interesting to note that the CS yesterday noted that one of the reasons why we have a very low collection of taxes is because of taxpayer apathy, to where they feel that there is a perception that the monies are not being used in the right way. And don't want to say it's a perception, it is what it is. We are being squeezed with taxes, but if you look at the rampant wastage that is happening in the government, it calls for a lot to happen. We have seen other countries in the European region that have maybe higher personal taxes than even we have, but people have, there is prudent use of those taxes. There, people are able to access basic amenities like healthcare, education, which are being provided by the government. I think if we got to that point where we have a feeling that the money is being put into good use, I think people can be willing to pay their fair share of taxes. Thank you.
Thank you, Kevin. And that brings us to the close of this discussion this morning. So I want to thank the participants who have joined us today. As Kevin mentioned earlier on, the bill is listed back to the National Assembly on Tuesday next week. The Committee of Planning will be tabling their proposals to the finance bill. That then will go to the next stage in Parliament. And remember that you still can lobby your member of Parliament to propose changes, even when the bill or the report of the Planning Committee has been tabled in Parliament. That bill can change even when it is on the desk of the president. The president can send it back to the National Assembly with a memorandum. So you still have a chance to influence and speak your voices in terms of ensuring we get what is good for the country. So thank you very much, and we look forward to see you in our next event. Thank you very much.